to stick with the health service companies and in the diagnostics now that we've got some more realistic expectations around the return to profitability. There's a lot of opportunity for self-help. And so you can see in the case of Helios, there's a company that has a lot of revenue, but it's been run very poorly. And they're now addressing real business 101 issues around their workforce efficiency. So there's a lot that they can do just internally to improve their profitability. And with those companies, all of the sort of long-term tailwinds remain in place. The ageing population, which we all hear about, but just to put a couple of interesting numbers around it, the 65s and overs, who are responsible for over 50% of healthcare spend in total, and they represent about 17% of the population. Their numbers are growing at getting close to 3.5% per annum versus a total population growth of 1.2. So there's the numbers, there's the volume growth. And then we've got, when we were talking about AI and machine learning impact in health, these companies stand to benefit significantly from that, both in terms of revenue, because there'll be new tests, new, more expensive tests, which boost their revenue line, and then in the costs, being able to facilitate better labour force management, where labour is their most significant cost.
Great. Justin, how about you?
Well, I think one we can talk to is BlueScope, and it's, I mean, the earlier question around where we've been adding to the portfolio. This is a stock we have been adding, and it's the flip of the story on iron ore and steel production cuts in China. So what we've seen is, because China's been pushing out so much steel into the export markets, you've seen steel spreads, which is the common number that's talked to by industry participants, which is the steel price less raw materials. So steel spreads have been at record lows, and that's been driven by, as I say, the China growth in exports. Now, if we're right and China's starting to cut production and will cut exports, then we'd expect those spreads to rebound. And for BlueScope, that'll manifest itself in two ways. They've got two businesses, one in the US and one in Australia. And in the US, which is the left-hand chart, you can see over time the amount of profitability or the spreads in this instance has been on an upward trajectory. And the reason for that is the chart that's inserted into that's US chart is improving concentration, so improving industry dynamics. The top four now represent about 75% of production, and the number of players has fallen. And there's more consolidation to come. So we think that industry structure is improving. So you'll not only get the improvement in steel spreads, but just through the cycle, we'll be expecting higher returns. And likewise, the right-hand chart here for Australia, again shows the level of profitability for the regional spread in Australia. And again, the business has improved. So you'll notice at the beginning of the chart, there was losses at the same steel spread as we have now. And that's because largely around the value-add products that they've now got in the business, such as Colorbond that we all know for the roofs. So industry structure's improved in both markets. The level of structural profitability is improved. And it's a good quality company. It's volatile, but if you average the last decade, the return on capital, I think, is in the order of 17, 18%. So a lot of value add. Yes, volatile, but years of exceptional returns, and it's trading at NTA. It's a $9 billion company, so we think there's a lot of upside, and the trigger will probably be steel spreads improving. So that'll be one for me.
Great. And Martin, to finish us off.
As Justin was alluding to, Nat, I still find that there's a lot of value in cyclical companies, because those ups and downs in earnings still tend to scare people way more than we think they should, in that the durability of earnings is far more important than the ups and downs. So some of the companies that we talk to, like the Seven Group and probably Brambles again, we'd say those companies that are really pushing efficiency, run the businesses well and stay low cost and efficient, always, I have a bit of a soft spot for them. I love companies that really try and drive efficiency rather than looking for the market to bail them out. So I do think that you can argue Seven Group's a bit of a Wesfarmers at a much smaller size, and I think they've done a great job of taking the cash flows from the WestTrac business, putting them into growing businesses like Coates and Boral, and I think they can keep on doing that. When they run businesses as well as they do, it is often surprising, as it's been in Boral's case, how much money they can make out of companies that were previously not very well run. So there are plenty of those, and some of our holdings in things like Fletcher Building still frustrate us in that lots of potential, but when you don't have that appetite to run the business lean and run it more efficiently, those the valuations tend to not reflect it. So that efficiency and where it's coming through in stocks like Seven Group, etc., and to be fair, things like Telstra and Brambles, we're still very positive on.